Hey everyone, welcome back to another Me Kevin Report. It's episode 97, and it's super exciting to be coming to you from, well, New York. So we've got New York in the background here. Hopefully everything is functioning okay. It is pretty wild to be doing this at 5:21 a.m. California time, and it's 8:21 here, and it's super bright and busy outside. Yeah, anyway, welcome to New York, I suppose. Anywho, okay, so we've got some data to review, and then let's talk about some of the entertainment that goes on in the world. So we just got the ADP report that came out, and it's kind of shocking. We've got a 278,000 job read versus the 170,000 jobs we were expecting. It's a very strong ADP report. Now, this is not the official jobs report, but it is the private jobs report that we like to use as sort of a tool for saying, "Hey, is the public report being honest with us, or are we getting tricked?" Well, let's just say $278,000, pretty dang hot. This is very similar to almost the JOLTS data that we saw yesterday, suggesting, hey, if you think the economy's slowing down, hold your horses. There might be parts of the economy that seem to be slowing down. As we know that the freight economy is in a recession. We know that Macy's just reported a slowdown in guidance for the rest of the year. They actually had a pretty good earnings report overall, but they did report a slowdown, and that slowdown led them to drop another 10%. Now, to some extent, that might not be a terrible surprise. A lot of people were fleeing to Macy's during the pandemic, and this idea that retail stores could keep this boom going, maybe not something that was realistic. Although Nordstrom's still doing pretty well, so some differences. But this hiring, some folks say, is seasonal for travel for the summer. Some folks say, look, this is just a company by company difference, and you don't have to be terribly worried about what's going on with the overall economy. And if you just look at the jobs data, kind of reiterates that. Now, what we'll do is we'll go through the actual ADP report, but what I'd also like to do is reiterate some of the things that are going on with the Federal Reserve and expectations for the Fed, because we just hit the lowest level of the 5-year break-even expectations at the same time as getting this ADP jobs report, which is odd. We would think that, wait a minute, how are we continuing to see inflation expectations plummet the way they are? And no matter which way you slice it, the reality is inflation expectations are plummeting. Inflation expectations now down on the 5-year break even at 2.09%. Now, this is the first time I've been able to say 2.0 for, basically 14 months. And my belief is that once that 5-year break even falls to about 1.6, that's when we're going to end up getting interest rate cuts. Now, again, I want to go through this ADP jobs report, but first, I think it's going to be quite interesting to look at this 5-year break even, and then we'll go through the details of the ADP report. So I'll put the 5-year break even up on screen here. It'll just take me a second. Let's see, share screen. I just need to click window, and it's going to be this one. There it is. Okay, look at this 5-year break even. So this is the actual 5-year chart of it. This is the 1-year chart of it. What's remarkable at that 1-year chart is, look at that, 2.0942 as of just the last seconds here as I took a peek at this. This is incredibly low, the lowest level finally that we've ever had. Here, this chart showing you the last 12 months. And then, of course, if we look at the last 5 years, you can see we are still higher than where we were after the pandemic. Here's your pandemic low. Sort of on the left side here. And before the pandemic, the last time we cut before the pandemic would have been over here in December 2018. And you can see that level was sitting right around 1.6 when we last cut. Last cut was roughly here, November, December period here in 2018. And or at least the Fed had some form of a pivot, right? And so we're still ways to go from there. but clearly on the right trend, which is fantastic. So now let's take a peek at the ADP jobs report. I do want to always start with inflation data when it comes out, though, and this is great on the 5-year break-even POV, and it somewhat aligns that once we get to that 1.6 level, Fed could be in a pretty decent position to actually cut. But we're not there yet. So what do we have here? So this is the ADP employment report. Annual pay was up 6.5%. This is probably the most important segment, in my opinion, to look at, is that annual pay section. What we don't want to see is a runaway of this median change in annual pay. We want to see this stable, right? Stable, or maybe potentially rising at a reasonable level. Somewhere between 3 to 4% is generally what's deemed consistent with 2% inflation. So you don't actually need 2% wage growth to have 2% inflation. The last time Jerome Powell touched on it, he recommended a 3% wage gain. So obviously seeing wages rise 6.5% is still relatively strong. You see that for job stayers, the increase was 6.5%. That's down from 6.7% in May. And for job changers, that gain was 12.1%, down a full percentage point from April. That's actually fantastic. So you're seeing a good slowdown here. You're still seeing wage gains, which is good for employees. Every time I mention this, people are like, "Oh, Kevin, what, you don't want people to make more money?" No, that's not what I'm saying. What I'm saying is we don't want this to run at an unsustainable level, because then it'll ultimately be worse for everyone in the economy. So this is good. This is consistent with this decline in inflation, potentially consistent with a pause as well. Now, I'd like to see where these jobs are coming from, because this is 100,000 jobs over expectations. And we also had a slight revision in the previous report, but only by about 5,000 jobs. So it doesn't matter too terribly much. What matters here is that we beat by about 100,000. And so what do we have? Well, we have manufacturing that came in at negative 48. Some folks suggest, yeah, well, we are in a manufacturing recession. If you look at the Chicago manufacturing, some of the leading indicators, at least in the Chicago region, this is very consistent with a weakening in manufacturing. It could just entirely be related to people buying less stuff. Natural resources, mining, construction doing very well. Actually quite well here. You can see mining up 94,000, construction up 64,000. Then we get to service providing, and look at that leisure and hospitality boom. 200,000 job gains in leisure and hospitality. Education seeing a decline of 29,000. We are going into the summer, though that is bundled up with health services. Financial activities, probably your investment bankers, mergers and acquisitions, and otherwise a lot of actually what happens here in New York. A negative 35,000, IT negative 15,000. And we're still, at least based on some anecdotal interviews that I'm doing with individuals in the in the IT space, we're not seeing companies that have started with layoffs actually return to hiring again. And I think that inflection point will be quite important. I was hoping that maybe artificial intelligence would lead to an initial inflection where we would start seeing a return to maybe some hiring again. I know that sounds wild. Some people are like, Kevin, why with AI would companies be hiring more? And I'll explain that in a moment. But we have not started to see any of that inflection, at least based on what we're seeing in not only these reports, given that information is still here negative at 15,000, but also just anecdotally in talking to individuals working for various different tech companies. And why this is important, or why I believe there could be more hiring because of AI, is strictly because of the belief that companies don't want to be left behind. So I have this belief that companies will recognize this AI boom and make more investments to make sure they don't fall behind, and that they can preserve their moat for as long as possible. I do believe that artificial intelligence narrows down the moat of companies substantially, but by hiring people potentially within the AI space, maybe they could catch up. Now, there is another belief that people would simply just be repositioned within existing companies into AI teams. That would not lead to net new hiring. In fact, that would be consistent with potentially continued job loss in information and technology. And so, at least tentatively from this ADP report, that's what we're seeing. Now, remember, this is the private report. We do have the public report that comes out tomorrow. Tomorrow morning at 5:30 in the morning, we will see the official jobs report come out. Now, the official jobs report, just to give you a forecast before we continue going with this report here, the official jobs report tomorrow is looking at a 195,000 jobs report with 164 for private payrolls. Unemployment rate ticking actually up to 3.5% from 3.4%. If we get anything like the report that we just got in the ADP report, wow, we are, yeah, we're not going to be able to say we're really trending towards a recession anytime soon. The employment can really keep us out of a recession. So, to some extent, this is a good thing for avoiding recession, especially if wages are low. Well, I shouldn't say wages are low. Wages are growing at a slower rate. That's the best way to phrase that. Now, we did just get productivity reads as well. We got non-farm productivity. We were expecting negative 2.4% for the first quarter. We actually got negative 2.1%, so a bit more productive than we were expecting. And here's another really good indicator. You ready for this one? Unit labor costs for the first quarter were expected to be 6% at an annualized year-over-year rate, and instead we got 4.2%. Very solid report. That's a solid report showing more strength, again, with less inflation. More strength, less inflation means no stagflation, no recession. That's good for now. Obviously, things could change. Again, we saw that with the Macy's earnings. We could get a complete flip-flop. And I'll go through some of the numbers for Macy's in just a moment as well. But looking at initial jobless claims, we get initial jobless claims of 232,000. That was right along expectations of about 235,000, with continuing claims actually coming in slightly lower than expected, and the revisions relatively nominal. Okay, so continuing with the ADP report. Let's use the correct button here. Oh, by the way, today is June 1st. That means this evening we do have that price increase set to go into effect for the programs on building your wealth, as well as the uh, building your income with the productivity course and building your income course, which is how to make more money and get SH19 done faster. The AI lectures drop soon. We actually have that moved for the 6th of June. Some incredible quality lectures coming out for the artificial intelligence side. And then with that price increase for the final pre-sale ending tonight. So take a look at those. Link down below. So, okay, what are the regions where we're seeing some of this pain? Look at this. This is really incredible. Almost exclusively, we have a slowdown in the south, with some in the mountainous region of the west, but you have massive growth in the Pacific, the Midwest, and the Northeast. Now, that's actually very interesting. South Atlantic, East South Central, West South Central, complete losses over here. I wonder if this is a bit of a reversal of what you saw during the pandemic, where during the pandemic you saw people essentially move from New England or maybe California over to Texas and Florida, and now you're seeing somewhat of a reversal. This is actually going to have large real estate implications as well. So I'd like to pay attention to this from a real estate point of view. That, wait a minute, isn't this interesting that we are seeing this almost job creation in areas that weren't doing so well in the pandemic boom? And now in a post-pandemic area, the areas that were some of the biggest recipients of the pandemic boom are actually seeing some of the biggest weakness in job growth. That's something to pay attention to. Something else to pay attention to. Look at this. The hiring is almost actually, it has exclusively been among small enterprises and medium enterprises. With if you take out the larger of the medium-sized enterprises, you can see most of the hiring is actually at businesses between 1 and 249 employees, whereas 250 plus employees, barely any hiring. and your largest employers losing or shedding employees. Fascinating. All right. Pay gains we've reviewed. Here are some pay gains by industry. And we've seen this slowdown here now consistently continue, which again, it's a good thing. This is a good thing. We want people to make more money, yes, but we do not want this to accelerate at some unsustainable level. So again, we're comparing to the ADP report or the prior release of the ADP report. This is fantastic. So very good. Again, a stronger ADP report with less inflationary concerns, leading likely to this 5-year break even, slowing down to the lowest level that we've seen in, quite frankly, the last year. You would have to actually even more than that. You would to get this low of a 5-year break even. You have to go to January 2021. We are actually at the lowest level of inflation expectations for the market in almost 2.5 years. That's remarkable. At about 4 months to 2 years, 28 months or so. That's remarkable. Now, when you look at Macy's, it is worth, I think, looking at Macy's in context of the broader economy. Though, somebody asked me, it was a course member asked me in the course member live stream the other day, oh, what about Macy's? And I said, yeah, well, I'm not a big fan of retail, but I'll say anecdotally, I've been to a few Macy's with the family, and they always seemed a little slow here recently. It was just a total anecdotal comment, but it's interesting to see that line up with what some of the numbers were coming out of Macy's. Macy's gross margin actually improved a little bit to 40% on gross margin, which is incredible. And their earnings were actually better than expected, but it wasn't this quarter that people cared about. It was the rest of which is really now in the past. It's the last quarter that they're reporting now. The current quarter and the forecast for the rest of the year were the red flag. In fact, Macy's specifically cited macroeconomic impacts to the consumer, as well as markdowns to address excess inventory, spring inventory. Macy's fell as much as 12% in the pre-market. Their forecast for the year on adjusted EPS was at a midpoint of about 295. They were expecting a midpoint of closer to about 380. That's almost a complete $1 reduction in EPS in their forecast for the year, and citing additional incremental clearance markdowns as well to get through some of the inventory they have. This is not an inflationary report once again. And again, I do believe that most of us are of the mindset now that, okay, we finally agree. Yes, inflation is finally going away. That doesn't mean prices are going down. It just means the rate of pricing growth has substantially slowed. And maybe they'll start going down, at least in specific industries. Retail might be one of those. And yes, the argument is that, hey, you realize, like, if you have negative inflation in certain industries, such as whether it's disinflation or just straight up deflation, and let's say retail or like freight, that could also lead to an earnings recession. This is true, but I think we have to segment out which industries might be going through that earnings recession in the future versus which have already gone through it. I think the argument can be made that the chip sector, for example, which is why I have a heavy allocation to it, I can believe that you can make an argument the chip sector has already seen its earnings recession, which was really more of your June through January earnings recession. So we'll see. But this I find very, very interesting. This overall, I think this is actually a very good news set of data. We've got the NASDAQ presently down just 10 basis points in the pre-market, market opening in about 50 minutes. You've got the S&P down, actually up 0.07, and the Dow down 15 basis points. Oil's basically flat on the day, and you've got the 10-year Treasury rotating down again to 3.62%. So overall and broadly, less inflationary fears, better results on the overall economy, likely consistent with the belief that the Federal Reserve will indeed pause. Yes, they're going to, make us be on our toes and make this argument that, well, even if we pause now, we might end up hiking again in July. I think it's bullcrap. In fact, after the Federal Reserve leaked this, leaked to the Wall Street Journal. I mean, some of them have been talking about it, but once you hear the leak in the Wall Street Journal, usually it's like, all right, that's what you need to start pricing in. As soon as that Nick T piece came out yesterday, guess what happened? The expectations for Fed rate hike flipped again. Remember how we were at basically a two-thirds expectation that we were going to get another rate hike? As soon as that article came out, the expectations flipped. We're back to two-thirds likelihood based on market pricing that we're going to pause. This is relatively consistent with the argument that Jerome Powell has made, and it's consistent with the belief that we're going to get our pause in June, which is great. That's in 2 weeks. Short of like some kind of really scary inflation report, this ADP report is not scary. It is consistent with a pause, which is fantastic news. Now, I would like to share this screen with you right here. No, it is not a reiteration that prices for the courses on building your wealth and making more money and the AI segment are going up tonight. So join them tonight. And if you need a bundle up, email us at staff@meetkevin.com. This instead is a graph that's known as the World Interest Rate Monitor. Now, I think it's a very interesting graph because it's also slightly complicated to understand. I'm going to provide the simplest explanation for it. So, a simple explanation of this tool is basically saying that right here is the highest we expect interest rates to go. Now, the market does not have to be perfect with this. This terminal rate right here is actually slightly above the level of 5.25. Our current interest rates are actually at this level where I've created this box. That's where interest rates presently are. And you can see there's a little bit of the market that thinks we still have a chance of a July hike, just a little bit. That little bit of excess orange right there is the pricing in of a July hike. However, you could see right after July, we go straight down. We expect our first cut to start getting priced into the market right here. This is December. You can see the market. Well, I mean, I guess you can't see what the market previously priced in because I don't have that chart up, but the market previously priced in rate cuts as soon as September. That has now moved over where you see these rate cuts here. We're coming in December. The market is expecting us to be in that 4.95 range, which would be consistent with about one rate cut. And coming January, the market is pricing in about a 4.75 midpoint here, which would be consistent with about two rate cuts, which is fantastic. That would be great, and the market seems to be anticipating this. And now the market does still believe that there's this chance of a recession in the second half. I personally believe with some of this hot jobs data we're getting, that the likelihood of a recession is probably going to be a lot closer to a Q1 of 2024 argument. We're going to start seeing economists kick the can down the road on this idea of a recession. And if they kick the can down the road, then what ultimately is likely to happen is we could avoid a recession entirely. So the further we go, the better. So I'm very excited about that. Now, I don't want to be overly optimistic. I want to be realistic with data. However, I do believe that we're being realistic based on just the data that we see coming in right now. I think it's safe to say that we are making a very clear argument for, ultimately, strong economy continuing for the rest of the year. Again, it's not going to be every segment, just like what we talked about with Macy's. It's not going to be every segment. But overall, I'm optimistic. And I think we have reason to believe that that optimism is somewhat justified. So that concludes the jobs report segment. Let's now see what else we have going on. So let's see what we've got in terms of some of these comments as well. A lot of money in the Northeast. Well, yeah, that's true. I suppose it depends where you're looking. If you're looking at like Hampton's real estate, apparently that's getting hit pretty hard. And I always think it's funny when people leave these comments. They're like, strong economy, laughing emoji. Well, it depends what industry you're in. If you're a trucker, you're like, you're smoking crack to think we're in a strong economy. But if you actually look at the data, we're like, wait a minute. The economy is not doing horribly poorly. GDP growth is exceeding expectations. Jobs growth continues to exceed expectations. Inflation continues to exceed expectations in the positive, and that it comes in lower. And yeah, of course, there are parts where there are problems, but broadly, it's very difficult to argue that the economy is broadly weak. That's very difficult to argue. So Yeah, I find that difficult. And MM says here, adjust for inflation. GDP is adjusted for inflation, right? These a lot of these indicate a lot of these reports are adjusted for inflation. And again, inflation is falling. So this idea that we're going to be able for years to be able to say, "Oh, well, just adjust for inflation," it's like soon inflation is going to be very, very low. I mean, yeah, there are potential reasons we might see a resurgence in inflation. We really want to pay attention to what's going to happen with the rental inflation rate, of course, especially because of what's happening with real estate data, which is just a much stronger result than expected. But in fact, median sales prices really on a nationwide basis only down about 2% year over year. You had a real good catch up in just the last few months, mostly because of this incredible lack of inventory. I mean, our inventory is down on a year over year basis somewhere by 200,000, 220,000 properties. There's so little to buy. It's incredible. Yeah, the reason this looks a little foggy, at least in my understanding, is because of the lighting in the background. But okay, so let's see. I'm a trucker delivering propane and had more work than I could handle. Made 3K this week. That's actually really incredible. Congratulations. That's great to hear. So can you show the chart that shows consumer debt isn't higher than it has been? So the chart that you're referring to isn't that consumer debt is not higher than it has been. The chart you're referring to is the chart we looked at yesterday, which is the ability for consumers to pay that. So what you would do is you would look at household spending as a proposal or on debt service payments as a percentage of disposable income. That would be what you're looking for. So yeah, I'd be happy to pull that up because I think that's an easy one to forget. So that chart would be right here. This chart shows you household debt service payments as a percentage of disposable income. And so you could see that percentage is really just on trend with what we've seen over this last decade. So we know that a lot of folks are under this impression that, oh, well, consumer debt is skyrocketing. This is true. Consumer debt is at a higher level, but our capacity to pay for that is not at a higher is not suffering from these higher debt levels, which I think is really interesting. By the way, if you like the way that I'm able to stream and I kind of throw up these mobile banners or throw up articles or reports or whatever, all of this right now is not being done with any kind of stream capture technology that's physical. It's all being done with software. It's all being done with StreamYard. So consider this paid promotion. Check out metkevin.com/StreamYard to learn more about that software. Help out the channel by going to metkevin.com/StreamYard and continue to support these free broadcasts. So thank you for that. I want to be clear. StreamYard is a paid promotion, but they're a phenomenal product that I absolutely love. Okay, great. So let's look at some other things here. Do you see opportunities to buy in longs? Yeah. So I just find it very difficult to be bearish at the moment, because again, the more bear reports I look at, the more I'm unimpressed by bear reports. I do want to be transparent that I am concerned by some things, such as the inverted yield curve and the depth of the inverted yield curve. However, when it comes to actual data, I'm not seeing it as heavily. Promotion, that's right. How do you like Eastern? I actually don't mind Eastern because, you can wake up at like a normal human being time. So I actually really enjoy Eastern. New car payment delinquency or repos. I'm sure we could get something like that. The car market is doing poorly. If you're looking for signs of recession, cars are probably the place to look. Credit tightening is happening the most in cars, in my opinion, especially subprime auto. Auto delinquencies for subprime I would expect would be very high. I think it's very difficult to sell vehicles right now, with the exception of some, maybe EVs, but in terms of regular cars, it's a difficult market. So I'd be interested. We could probably get some auto data here. Let's see if I get some auto loan data. But yeah, autos are getting hit hard. So consumer loans, LTVs. Let's see what we can. Oh yeah. Well, here's an example for you. This is actually consistent with what I suspected. But look at this particular chart here. That's not the chart that I wanted to show because that's the same one I had. Hold on. Let me get used to what I'm doing here. There we go. I pressed the wrong button. It was a user error. There we go. Net percentage of domestic banks tightening standards for auto loans. As you can see, it's the auto loan sector that is seeing the substantial, and this is based on Q2 2023, a substantial increase in the tightening for auto loan standards, almost consistent with the levels that we saw in the pandemic, with 55% of banks tightening standards for auto loans. Right now, only about 27.5%. However, well above what we had seen in the decade prior. So you clearly see an expansion of tightening for, auto standards. And I think if you, well, I see this at least. If you look at the auto Twitter space, you consistently see this fear over, oh my gosh, autos are clearly in a recession because banks are continuously cutting dealers off of lending. It's getting harder to find lending for autos. The subprime auto sector is getting hit. Delinquencies up, repossessions you would expect are up. None of this is a terrible surprise, though, and it would be consistent with the credit tightening that we're seeing, really driven by the Federal Reserve. So, and subprime is going to be the segment that first gets hit, always. Oh, it always makes sense that subprime gets whacked first, and that's what we're seeing. So, yeah, I'd like to get some more data on delinquencies, though. Let's see, delinquency rates, at least on the St. Louis, the Fred website, they're a little more difficult to grab. And then if we look at auto loan delinquency rates, 90 days or more for all auto loans, rather than just the delinquency rate for subprime, you're not seeing a substantial explosion. I mean, you could look on screen now. You could look at Y charts here. We're at a 3.89% Q1 2023 90-day or more auto loan delinquency rate. That is substantially lower than what we saw, obviously, during COVID. In 2018 Q2, we were even higher at 4.17. 2019, we were 4.6. Now, it's possible that because this is 90 days late, there's going to be a lag in this data, but we shall see. Again, I really think you're seeing more repossessions and more issues in subprime than in the broad auto market. This chart here being specifically referring to the entire autos market rather than just the subprime sector. Now, if you do look at subprime specifically, there is an Axios piece out, and Axios makes it very clear that low-income households are falling behind on car bills. And this is really what you have to differentiate with, is that there's subprime auto and then there's prime auto. So a subprime auto score is usually considered to be under 620. So if your credit score is under 620, my friends, you are probably in a recession because you're looking around going, food's more expensive, everything's more expensive, rent's more expensive, cars are more expensive, I can't get a loan for a new car, getting screwed left and right. If you have a low credit score, under 620, or you are a low-income household, you probably feel this recession more so than anyone else. Now, there is the argument to be had that the wealthier individuals, that would be like your white-collar individuals, are also feeling the recession quite hard, or this recessionary time, specifically because of this fall in asset values that we've seen. But most of that pain was felt in the second half of 2022, not so much now anymore, since we've seen so much of a recovery. So I find this this consistent with what you would expect in a recession. That yes, or a recession, or this sort of tightening process, whatever we call this, recession of last year or tightening process, whatever you want to call it. I would find this pain in lower income households falling behind on car payments and subprime auto delinquency rates exceeding what we've previously seen. I would find this consistent with the environment that we're in right now. As you can see, it's actually not that much higher than what we saw between 2017 to 2018 or during the recession of 2008, which is kind of remarkable. You would think that this line would be higher. This is probably going to go up even more. So stay tuned. I would probably see this go up even more. So some comments here about Carvana being a joke. I think that goes without saying. But yes, thank you for reiterating that. Consumers with low credit scores are falling behind on their auto loans at a record rate. And this does lead some people to be able to create this sort of clickbait of, oh my gosh, recession. Just look at the auto sector; it's imploding. I don't find a consistent argument to suggest that the entire auto sector is imploding. I do think that the auto sector is seeing price decreases. I think it's seeing a normalization of inventory, and the lower end is certainly getting hit harder. That is clear, without a doubt. Uh, but I don't see this at crisis levels. We'll see. But anyway, the share of payments on so-called subprime auto loans that were at least 60 days late rose to more than 6% in December. Subprime loans have high interest rates that are typically made to people with low credit scores. Delinquent payments are the first step towards default in the car being possessed. The December delinquency rate is a record, eking past prior peaks just before the pandemic, according to S&P Global. The uptick reflects the steady weakening of the finances of poorer American households. For one, the cost of living has surged. Now, not only has the cost of living surged, but now you're seeing, again, it's becoming more difficult to actually finance these vehicles, as well as more expensive rents and more expensive food prices is a problem for poor individuals. In fact, there is an argument to be made that we might see the return to some form of stimulus, stimulating of the economy, stimulus of poor individuals specifically, because of the disproportionate burden they might share in this correction that we're going through, whatever it might be called. So you could end up seeing, in my opinion, if we ever did return to stimulus checks again, I think you would see something that was very tailored to your lower end. I would say that would be individuals making less than $40,000 a year. That's also very consistent with what we saw during the pandemic with Mitch McConnell programs, right? Mitch McConnell programs consistently uh, aligned with, hey, let's give people who need the money the most the money. So give people making $40,000 or less stimulus checks or more unemployment benefits, but don't preserve that for households making up to $200,000 or in California where they're handing out stimulus checks to households making over $500,000. That's just insane, right? That I would not expect to see any kind of return to that sort of level of stimulus, not anytime soon. So, furthermore, let's look a little bit more at this Axios piece because I actually think it's pretty decent. The subprime sectors of both mortgage and auto finance tend to have higher incidences of practices perceived to be predatory as well. Yeah, this is also true because you're getting, there was a piece in the Wall Street Journal a couple months ago, and I could be wrong in my memory or recollection of it, but I believe it stated that 70% of subprime autos, loans that are made, could default, and subprime lenders would still be profitable. They would still be profitable because subprime lenders charge so many points up front to even make your loan that they make most of their money up front. And the fact that you default is almost this foregone confusion, or a conclusion rather, which is quite remarkable. And it's unfortunate, but again, a lot of this is just consistent with what you would expect with higher interest rates. So again, we'll pay attention to it, but I don't know that I would consider this a red flag for the broadest parts of the economy. All right, let's see what else we have here. So. Ha, 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 ha. Let's see here. All righty. Yeah, there's Musk has been in the news quite a bit here in the last couple days, and his trip to Asia. Just had an interview as well with the Babylon Bee. I thought that was very interesting. And let's see here. Talk about more investment into China. Some folks are decrying Musk's investments into China as being required by Shanghai, which to some extent they are. And that was the benefit of putting up a Shanghai facility, is this idea that there would be expansions in the future. Musk says Shanghai's plant cars are of the highest quality. He's regularly kind of bagged on the Fremont plant in California and praised Shanghai as actually making higher quality cars than the California one. And part of that could be because it is a custom built factory as opposed to what you see in Fremont, which is a conversion of an old GM facility. Uh, Musk bashes liberals for having, quote, no sense of humor. That could potentially have to do with the the AOC press fake account that is circulating on Twitter. I find that very entertaining. So, looking at some of the other Wall Street commentary that we're seeing, China's growth stall will keep global disinflation trend intact rather. Now, this I think is also very interesting. So let's take a minute here just to address China. China is slowing substantially. China generally grows at a rate of 8 to 9%. It is expected to only grow at a measly 5%. However, that expectation was propped up based on what we saw in Q1, which was relatively propped up on services spend and pent up demand spend. And as that fades, China's economy might not grow at 5%. It might not even grow at 4%. It might grow at closer to 3.5%. That could actually put downward pressure on commodities. You could look at futures for iron ore, copper ore, and see exactly those industrial metals slowing down. It also puts downward pressure on oil. Oil prices certainly way lower than individuals have expected. We're back down to pre-Ukraine war timeframes for oil prices. And while there's talk that OPEC is once again going to cut production, they just haven't announced that yet. And so the oil market so far has not reacted terribly positively to this idea that, oh, yeah, definitely more cuts coming. Instead, more focus for oil pricing and inflationary pricing is focused on China. And this negative outlook for China, as much as it's bad for Chinese individuals, it's absolutely fantastic for the globe because what you're doing is you're literally flip-flopping what people expected. Now, this really excites me because you talk to me about flip-flopping, I get excited, okay? But think about this for a moment. Last year, markets had this expectation that was fallacious, but they had this expectation that, oh, as soon as China ends COVID zero, we're going to see this massive inflationary boom, and China's going to contribute massively to inflation. Commodities are going to skyrocket. Oil's going to skyrocket. Manufacturing inflation is going to skyrocket. Everything's going to skyrocket because of China. China's reopening is going to cause this massive reinflation. Instead, what you have it had happen in Q1 and into Q2 here is this, okay, China just kind of went back to normal for the first, 5 months of 2023. But now what are you seeing? And you're seeing this consistently in reports from UBS, Goldman Sachs, Barclays, Morgan Stanley. I read these reports regularly. What I'm seeing consistently in all of them referring to China, I'm just giving you a quick bottom line here, is they're all talking about a massive slowdown in China. In fact, Wall Street today, via Bloomberg, discussing, quote, this is likely to continue for the time being, given the situation in China. After another false start, China's outlook has taken a negative turn. Real estate activity continues to decline. House price growth is low. Yields have started to fall again. Imports have dropped, all reflecting stagnating demand. The typically surefire sign all is not well in China is when capital outflows pick up. And guess what? That is exactly what appears to be happening. Rising outflows of capital once again in China. People trying to get out of China. And a lot of the wealthier folks in China tend to move their money over to wealthier districts such as Singapore or otherwise, Hong Kong. But China's clearly in a slowdown, which is the exact opposite of what economists were projecting at the end of last year. And I remember saying that on this channel too. I'm not trying to pat myself on the back, but I made it very clear. I thought this China's going to reactivate inflation was just complete bullcrap. And sure enough, it ended up being complete bullcrap. Now we're getting this complete flip flop. I mean, look at this. This chart right here shows you capital outflows from China, and how you're seeing more capital outflows from China. With this over here is the outflow gauge. And while you had a recovery during the reopening and you saw less outflows, less of a negative number, we're now going more negative again. Falling again implies rising capital outflows. It's crazy. Or maybe it's not. Maybe that's kind of to be expected. And maybe this is why you shouldn't bet against America. This is why at the end of last year, when everybody's like, oh, Kevin, I want to invest in Chinese companies, I'm like, The only exposure I want to Chinese companies is via American companies. That's it. That's the only exposure I want. I will not invest in Chinese companies. I don't trust Chinese companies because I don't understand China. I don't understand their accounting. I don't understand their books. I don't trust their books. I'm not interested in China with beyond how I would trust American companies to go figure it out. And that's not to say all American companies are angels. It's just to say I think they're more angelic. Anyway, so if reserves are not growing despite China running a large trade surplus, this tells us capital outflows must be leaking abroad. This also explains the yuan's depreciation. The fact that China has not been leaning against the weakening currency tells us that they are allowing it to decline as a pressure valve to decrease capital outflows. China's slowdown will keep the pressure off global commodity prices, therefore, allowing global disinflation to continue. And then, of course, there's always got to be like the clickbait part for the article. However, watch for signs when China is likely to re-stimulate, potentially in a flood-like manner, a sign for when the disinflationary trend could reverse. In other words, if China turns on the money printer again. Yeah, I mean, I suppose it's entirely possible that China could turn the money printer back on. But yeah, again, investing in China is not the most exciting idea right now. In fact, you have more of a risk to a downside in China. Though, again, much like we talked about stimulus potentially coming to the lower income cohort in America, you're likely to get more stimulus in China. However, remember the history of inflation or stimulus in China. China tends to stimulate property developers and corporations, not individuals. Here's another piece in Bloomberg talking about European stocks with high exposure to Chinese markets are counting on further policy support from Beijing to reinvigorate their gains. The trouble is, the prospect of major stimulus appears poor. Since the Lunar New Year holidays in late January, baskets of European shares with sizable income from the country have lagged behind the Stoxx 600. The Euro Stoxx 50 generates 1/4 of its revenue in Asia. This is pretty common of a lot of American companies as well, like Nvidia. 1/4 of its revenue is actually specifically from China. Certain sectors China has become a vital source of demand for, such as miners and tech companies. Some tech companies relying on China for as much as half of their revenue. Among industrial, auto, and luxury spending stocks, the share is around 15 to 30%. And almost all of the latest data points indicate rather that China's economic comeback is sputtering. Yes. Yes. This is exactly correct. But again, it's not a bad thing. If you are here in America or in Canada or in Europe, you should look at what's happening in China and say, thank you. Thank you for contributing to global disinflationary pressures. That is good. That is a good thing to avoid a tighter Fed and a recession. Remember, folks, Jerome Powell does not want to force a recession if he does not have to. Right now, it does not appear we need a recession to get inflation down. Yes, it is possible that the Fed has over-tightened. So far, we're not seeing indicators that is true. So again, yes, it's so funny. Again, somebody left me this comment the other day, and I don't know why it's bothering me so much, but they're like, "Oh, well, you're just a permeable," and I'm like, "I was the first finance YouTuber to flip-flop. I flip-flopped so freaking fast. People are like, you couldn't possibly have flip-flopped in the span of 48 hours." I'm like, no, I did, and here's why. I mean, I went on multiple interviews explaining why I was so fearful of what was coming and why I flip-flopped. And nobody wanted to hear it. But yeah, I mean, unfortunately, it wasn't popular to be a bear now. It was not popular to be a bear in January of 2022 when I was a bear. Now, ironically, it's not popular to be a bull. People are more bearish. It's just like, to some extent, though, I kind of like that because, if you're doing what everybody's doing, you're probably doing it wrong. That's just the contrarian point of view, though. So it's not always the case, but it's one of the indicators. So anyway, this China slowdown, fantastic again for inflation. Here's another piece, actually. What is this? China is rolling out the red carpet for global business leaders like Jamie Dimon and Elon Musk. That's true. Both of them just talking in China and pitching how great China is. Even Apple, like, we're not trying to decouple from China. We're just putting a little bit of a production somewhere else. Chief executives from JP Morgan and Tesla both met separately with senior Communist Party officials this week against a backdrop of tumbling Chinese markets and disappointing economic data. This was another thing I talked about as well. China, people are like, oh, China's going to, punish Tesla. No, they're not. When you look at the Chinese, the South Chinese Post, whatever it's called, I look at I have their iPad app. I look at them every day, almost every day. I think it's funny because it's pretty much Chinese propaganda written in English. It is a Chinese-sponsored news website, state-sponsored, and I love it because it basically tells me what the Communist Party of China thinks, and they basically just get on their knees for Elon Musk. And I'm not trying to be offensive. I'm just trying to be realistic. They use Shanghai as a bragging right because think about it. If you can go to Apple and say, look, we know you guys are going to India and you think you want to set up manufacturing infrastructure over there. How about we also get on our knees for you and help you build a new factory over here in China because we really need it. What can we do to convince you to get over here? That is the kind of stimulus that I expect China to continue with. Not people stimulus, company stimulus. If you want corporate welfare, China. Members of the Chinese powerful Politburo also sat down with executives from Starbucks in recent days, with top ministers welcoming leaders from investment firms and other semiconductor firms. NVIDIA, Jensen Huang, also made CEO, also is heading to China this month, according to people familiar with the matter. He was just in Taipei. Flurry of engagement comes after an espionage probe into expert consultancies used by firms to operate in China, spooking foreign investors. But Xi Jinping calling on protecting industrial security as a priority of priorities. Okay. Nervousness around anti-foreigner sentiment comes as China faces a sluggish post-pandemic recovery, reporting weak manufacturing and export data, as well as a property slump. Geopolitics has also made investors wary as U.S. President Joe Biden leads a global campaign to block China from high-end chip manufacturing via the CHIPS Act. Though Joe Biden did recently talk about this cooling potentially coming in relationships or thawing of relationships coming between China and the United States. Makes you wonder, can Biden go to China? Like Nixon goes to China kind of thing. Foreign direct investment, FDI, in China has also plummeted, with investors pulling $30 billion out in the first quarter. And that's foreign investors. We have more outflows when you look at even just individuals within China. The MSCI China index is down more than 50% from its 2021 peak. Chinese stock market not doing that well year to date either this year. And this resumption of global business leaders engaging in person with Chinese officials is reminiscent of a friendlier era, really from before the pandemic and this 3 years of isolations and lockdowns. You've also now got political leaders like Olaf Scholz of Germany and the ECB president Ursula von der Leyen using recent trips to China to press Beijing on hard topics such as territorial claims on Taiwan. This is actually kind of important. Now, a lot of people think China is going to invade Taiwan. China has got an economy to worry about, folks. Their economy is not strong enough to invade Taiwan. And while they might wave the saber, so to speak, they would absolutely destroy their global standing, and they'd become ostracized like a Russia. It'd be so stupid to invade Taiwan. And I know that makes for good clickbait, but it's just nonsense. It's not something that I build into my forecast as a base case. I could be wrong, but it just seems nonsense, especially with the position China's economy is in now. They remember what they talked about in their Chinese Communist Party Congress, which happens every 5 years. They literally talked out of both sides of their mouth. You can't make this up. They're like, I'm going to paraphrase here. Capitalism is great. We still believe in socialism, but capitalism is actually really nice. Socialism is great. Don't worry. We still believe in common prosperity, but capitalism. It's actually a great thing. Uh, you could read the translations of the party Congress statements, and you'll see exactly what I'm talking about. I find it very interesting. So that gives us an update on China. Okay, so I did start today's Me Kevin report a little bit later. I blame still being awake at 3 a.m. in New York. So yes, I blame myself, but that's okay. Kevin across from Central Park. It is very beautiful out there. Yeah. Anywho. So, okay, good, very well. What else do we have? Anybody got any commentary? Let's see what we got in terms of Wall Street. Remember, again, prices increasing tonight for the programs on building your wealth. We're going to be going to the course member live stream, which you get lifetime access to for however long we do the course member live streams. When you join the programs on building your wealth. I've been doing course member live streams since like 2017. Is it 17? Maybe it was 18. It was 2017 or 18. It might have been 18. But it was kind of neat because, we have an archive of course member live streams going back to the pandemic. It's crazy. Crazy time. March of 2020. Oh, that was crazy. Anyway. All right. So Bill Dudley talking about the Fed needs to push rates higher, whatever. Fed hawkishness will be kept at bay by China's angst. Oh, really? China's faltering recovery will restrain U.S. and global inflation. Okay, thereby capping Federal Reserve hawkishness. It was supposed to be revenge spending that did it. Almost after 3 years of lockdown, the ending of restrictions in China was expected to unleash a flood of repressed consumers ready to splurge. But if revenge is a dish best served cold, no one's eating it. China is in the midst of yet another false start to its recovery amid deteriorating economic backdrops. This has knock-on effects for the U.S. and the rest of the world. I don't know why that was so entertaining to read. But yeah, that's roughly what we've already talked about. So I'm not going to double down on that. Of course, remember live streams are the best. Oh, thank you for saying that, Dennis. When would be a smart time to try to get a mortgage loan to prepare for an opportunity? I mean, it really doesn't matter. It honestly does not matter when you get a mortgage. Now, you might be like, what do you mean, Kevin? Mortgage rates are like 7%. Bro, just refinance when rates are lower then. Just make sure you can afford it now, right? You never want to go in expecting to refinance. But it really does not matter when you get a mortgage because if rates go up, you got a better deal. If rates go down, you refinance. Where's my coffee? This is actually a good question. I am doing this Me Kevin report on zero coffee right now. I don't know if you can tell. I actually feel pretty good overall. I don't know. I get allergies. Maybe I should stop being next to the park. I get allergies when I come to New York. Not as bad as when I go to Texas. I don't know what it is with Texas. Texas kills me when it comes to allergies. It's crazy. Started watching in 2017. No way. That's amazing. I would love to live stream Rust. Maybe one day we will. But I haven't played in like a week. That was too much last week. Well, it was one day, but it was a good day. Do you think AI could lead to what happened during the Clinton era, where the technological boom boosted GDP and pushed the debt ratio down to 33%? Yes. So this is basically a way of saying if our economy is, $23 trillion strong and our debt's $31 trillion strong, we've got way more debt than we have GDP right now. Could AI lead U.S. GDP to exceed our debt? Absolutely. Absolutely. Hey, Eric, you giving away the secrets, man. Yes, I actually am. I really want to today double down on a real estate discussion. In fact, you know what I think would be really cool? And I'm going to invite everybody to do this. Go to metkevin.com/chat. No, you don't have to pay for it like the courses link down below. But go to metkevin.com/chat and join that Discord. And then go ahead and scroll down all the way to the bottom. Scroll down to Meet Kevin General. And we're going to do questions for Barbara Shark Tank. And what I'd like to invite you to do as a Meet Kevin report watcher here is leave me some questions there. It'd be very nice to have your questions there. Leave questions today for Barbara interview. Again, go to metkevin.com/chat, chatola, tola. And yeah, you could join the Discord. There's a free segment of it, and I just want to make sure that you are all able to actually do so. I could see you have an emoji reply. I'll make sure the permissions are right, so maybe somebody else can write something to double check. It should work, given that I put it over here into the general segment. But anyway, yeah, it's gonna be really fun. The year you hit 200K, so yeah, you can mess. Oh, thank you so much for saying that. Okay, yeah, just so you can see what that looks like. By the way, this is Discord, and I just added this under the Meet Kevin General tab right here. Ooh, look at the little spinning on my icon. Isn't that cool? All right, let's take a quick check of the markets. Let's see what we got, and then we're gonna hop on over to the course member live stream. All right. Tesla down 0.4. NASDAQ just went positive, 3 bips. NVIDIA up 1.4, although they were down like 4% yesterday. And what else is on the watch list here? A lot of things. Let's see. Turns of evil sideways on the phone. Extended hours. C3AI down 19%. Not a surprise. It's a loser of a company. I've been bagging on that company forever. Lucid's down 12%. Okta down 18%. CrowdStrike down 9%. Salesforce down 7%. Wow. Macy's actually only down 3% now. They were down more earlier. SoFi slowing down on that sort of momentum movement. They got 3.75% to the downside. And some miscellaneous reporting here. And then towards the upside, you actually have Carvana and Nordstrom up about 5%. Yeah. Blah, 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 blah. Okay. Cool. Very good. Thank you so very much for being here, folks. Appreciate y'all. And we'll see you in the next Meet Kevin report. Good luck and